Well, today we will finish up chapter 24. We just have one section of it to go over. And then we will cover the first section of chapter 25. That's where I got to in my first class. So we'll do the same. So it won't be a bad session at all. We're well ahead of the game. So that's just fun. So hope everybody's doing okay on this rainy day. I didn't really expect it to be rainy out there. Well, we never know Florida weather. So if you're watching via Zoom, let me go ahead and share my screen with you. So chapter 24 is all about performance measurement. We're trying to find out how well some division of a company did. It could be a large chunk, like an investment center, which is like a subsidiary, like General Motors having Chevrolet, Buick, Cadillac, GMC. It could be an individual department within a company, might even be an employee. So we're trying to measure financial performance. But what I would like to talk about in this section is financial performance of investment centers. And the reason I would is because we're going to have three financial measurements. They're new to us, or relatively new. And you'll also see these three coming up in managerial finance. Most of you are going to have managerial finance either in summer semester or fall semester. How many of you are going to have it during summer? Anyone? Yes, online. Okay, maybe. Are you both going to have it during fall? I forget. Oh, you might going to do the financial accounting instead. That's right. Yeah. Are you going to have it during fall? Oh, okay. Yeah, that complicates scheduling when you have two majors, definitely. I forget, what was your other major?
No, I said I've had to
Okay, that is a lot. Yeah. So, measuring the financial performance of an investment center. Well, for an investment center, we're talking about a very large chunk of a company. Again, like a subsidiary, such as General Motors having Chevrolet, Buick, Cadillac, GMC, etc. And as it turns out, an investment center has control not only over its revenues and expenses, but also over the amount of assets invested in it. It's just like a business within a business. So looking at an investment center is usually a very large division, of course. It cannot be evaluated solely on income, as income does not measure how efficiently the division is using its assets, because there's no measurement of assets within that. So we want income to be as great a percentage of assets as possible. Instead, it can be evaluated on three other measures, and these are discussed below. So the first one we see a little bit on return on investment. And it means operating income divided by total assets. Well, sometimes this is expressed in its extended form as the following, where return on investment equals profit margin times capital turnover. One of those two. Well, profit margin equals operating income divided by sales revenue. So that is the percentage or proportion of sales revenue, which filters down to the bottom line of the income statement as operating income. What would we like? We would love for that to be as high as possible. We want to be as profitable as possible. Just like for return on investment, we want that to be as high as possible. We always welcome more profit. And then capital turnover. That equals sales revenue divided by total assets. So what is the proportion of total assets that is returned to us as sales revenue? Again, we'd love for that proportion to be as high as possible. We'd love to be more, we'd love to have more sales revenue. So as I said, number 2, higher is better for all these measures. And you'll see all these in managerial finance. They're not difficult. Then residual income. What's that? We mentioned it briefly the other day. Well, that means operating income minus minimum acceptable income. Well, what's that? Well, minimum acceptable income equals management's target rate of return. It will be stated as a percentage and will be given to you. Multiply that by total assets. Then we subtract that from operating income. So this is the residual left over. It's how much extra income we have. Obviously, we'd love to have more extra income. So higher is better. Then economic value add, EVA. It's a special type of residual income calculation. Now it looks at a division's residual income through the eyes of the 2 primary stakeholders, at least external stakeholders, which are investors and creditors. It considers potential income available to these stakeholders. Excuse me. The assets used to generate the income, and the minimum rate of return required by the stakeholders. And the latter is called the weighted average cost of capital. So that's whatever percentage they would like to earn. And it replaces management's target rate of return, which is used in the residual income calculation. So here's what EVA is if we calculate it. We take after-tax operating income and we subtract off what's in brackets. We subtract off total assets minus current liabilities. So let's see how much total assets exceed current liabilities. And we'll multiply that by the weighted average cost of capital percentage, which will be given to us. And again, higher is better. Because if you think about it, we would love to have as much extra income, if you will, as possible. We always want more income. How do those seem? Pretty easy. You have the formula. Yeah. If you have the formula, you can plug and play. Simply plug in the numbers you're given, and you'll do that in homework. We'll then ease some limitations of financial performance measures. They include the following. First of all, measurement issues, such as how to value total assets. For example, should we use historical costs? Should we use current fair market values? Well, it depends upon the company's choice. Second, short-term focus, because these reflect what just went on in the past. In fact, number 3 there says focus on historical results. They show us what just happened last year. And our assumption is that what happened last year is roughly going to project into next year. But that's not always the case. And they're not good for mapping out the future at all. So that takes care of chapter 24. Any questions there? Okay. All right. If you're watching via Zoom, I'm going to go ahead and bring you back live for a little bit. So the next thing that we'll get into is chapter 25. As I said, just the start of it, the first part, and that's non-computational. So it's a non-computational day. In chapter 25, the title is short-term business decisions. And yes, what we are looking at will be short-term business decisions. In other words, generally under a year. Sometimes a little bit longer. We've got one we'll look at for 3 years. But we're going to be comparing relevant costs and relevant revenues. Well, the chapter is going to be teaching us some very, very logical ways to make some business decisions. And we can even apply a lot of this personal decisions in life. So it really is a useful chapter and gives you a very logical way of thinking. In fact, I was talking about it with Selena Josie, one of the other managerial instructors, about a week or so ago. And she and I agreed this is maybe the most important chapter that we teach in this course. It really is something that can change your way of thinking for decisions. By the way, does everyone always make decisions logically or rationally? No, not all. So, whoa, there go the lights. So this one can definitely help us be more rational. You'll see what I mean as we go through. Let me turn on the lights. Didn't even have to touch it. All right. Let's see if that doesn't look so good on screen. Let me just see if there's a marker way down here on that screen. Let me just make some squiggly lines. Ooh, that's terrible. I don't have a black marker up here. There are 3 red ones. That's good. There, well, it's really sealed. All right, which is better, the blue or this red? The red, thank you. I figure it would be because it's sealed nice and tight. Because these do dry out on the wrong edge. And where did they leave? An eraser. This one. So here's the setting for the chapter, the root foundation for it all. We're going to have a variety of business decisions in which there are two or more alternatives we can choose from. So we'll have decisions such as follow. Looks good. Okay. Such as whether to keep or replace a machine that we have. So there are two decision alternatives. One is keep, one is replace. We're going to analyze that decision by looking at each alternative and seeing the so-called relevant revenues and relevant costs are involved. I'll show you what they are. But those are the ones that make a difference to the decision. We'll have another type decision, which involves, do we insource our product or outsource it? Insource means we make it. Outsource means we let someone else make it for us and we pay them for it. Another type will be, should we accept special order or reject it? If we accept the special order, well, that means customers come to us, they want a large quantity of our product, but they want a special price. Sometimes worth it, sometimes it isn't. So we'll see some other decisions along the way too. But again, each decision has at least two different decision alternatives. Alternative 2, for example, could be to keep that, or alternative 1, pardon me, could be to keep the old machine. Alternative 2 could be to replace with the new. So we'll see why is in our best interest from the standpoint of profitability. So again, we'll approach it very, very logically and very rationally. And I think this chapter is going to make perfect sense to you. It's not bad. If you're online, let me go ahead and share my screen again. So here we are with the chapter 24 and 25 notes, short-term business decisions. And we'll cover the introductory part here today. Again, non-computational for now. We'll get into computations later, but they're not difficult ones. Seems like the rain has stirred up allergens out there, pollen, etc. Something. Usually does. And sometimes spring here can be a really bad thing to have to go through. So, introduction. Well, we'll be examining the income effects of alternative management decisions in this chapter. So, like alternative 1, keep the old machine. Alternative 2, replace it with a new one. We obviously want the decision which is going to give us the highest income. And our basic decision rule here is going to be to choose the alternative which most increases net cash inflow. That's a proxy for income. And as with other scenarios in managerial accounting, the cash basis is more important than the accrual basis because managers are concerned with cash inflows and cash outflows. Cash swap pays the bills. In the long run, you may have remembered from someplace in financial accounting that if we total up all the net cash inflows over a business's life, and total up all the GAAP or accrual accounting net income figures over all the years, the two totals will equal each other. So it's only a timing difference between the two. But managers tend to think in terms of cash inflows and cash outflows. They really do. Cash swap pays bills. Plus, they may have forgotten about accrual accounting. May not remember too much about their financial accounting class. So, we'll think in terms of cash inflows and outflows here too. Now, to a small business, by the way, cash inflows and outflows make perfect sense. Cash inflows, how much money is coming in? That's revenue. Cash outflows, how much money is going out? There are expenses. And the difference between the two, net cash inflow, that's profit. That's how much money is left in the bank. Makes perfect sense. And many small businesses do use the cash basis. Because after all, in a small business, has anyone really studied financial accounting? No. Pardon? Right. Other than that financial accounting class, no. And a lot of small business owners, they never even took it. For example, if we went out here to most any small business, we went to Reese Cliff Restaurant, if we went Southside Cleaners, if we went to Payne Air Conditioning, a little bit north of here, you can bet none of those business owners have studied accrual accounting, also known as GAAP-based accounting. So they don't understand it. No, they have no need. So we'll think in terms of cash inflows and outflows very easy. Now in B, the term relevant costs and relevant revenues, those are going to differ between the alternatives under consideration. And we'll usually evaluate alternatives in terms of future and not past cash inflows and outflows. I'll be showing you. Relevant costs include outlay costs, which means cash expended directly out of pocket, and possibly opportunity or foregone costs. So an outlay cost is money that we spend directly out of pocket. For example, if we were deciding whether to insource or outsource, there go the lights again. If we were to make our product, which means insource, one relevant outlay cost we would have would be the money we spend on direct materials. And I will be showing you this in numbers later on. And relevant revenues and relevant costs be very, very, very obvious. Then a relevant opportunity cost. For example, if we were insourcing the product, we have to take up some floor space to produce it. Well, let's say that we could have rented that floor space out to someone else. Well, that revenue that we give up is actually an opportunity cost. So we'll consider it. I'll show you how to do a special analysis. And sometimes relevant costs and relevant revenues are termed differential costs and differential revenues. Your book tends to use the term differential, sometimes uses the term relevant. So I just want to make sure I include both so that you'll know. Well, next, if a cost of revenue is not relevant, it's going to be irrelevant. So irrelevant costs and revenues, they will not differ between the alternatives under consideration. And irrelevant costs may be outlay costs, they may be opportunity costs, or they may be sunk costs. What's a sunk cost? Well, sunk costs result from past decisions. They represent past cash outflows. They're not relevant costs because they won't differ in the future between the alternatives. In fact, if we have already spent money, such as we already spent money to purchase our old machine some time back, that's a sunk cost. We're not going to get it back. It's just too bad it's out the door. Now, if we can get some future salvage or residual value for it, some cash to sell it, to junk it, that is relevant because it will occur in the future. We can control that with our decision. Our decision will not change the amount of money we spent on the sunk cost. That's just money out the door. Well, do you think the people try to include sunk costs though? Oh yeah, they really do. There's been a lot of research on that, including in psychology. And relevant to that, also people tend not to give up the past. So even though they would be better off moving on from some situation, often they tend not to. So they keep on hanging on, for example, to a relationship with some person, even though they would be better off without the person. But they'll think, oh my, I've invested all these years in the relationship, all this money in it. Well, those are sunk costs. In that case, both monetary and emotional. Reading on, sunk costs include historical costs of assets, just like the original cost of the old machine that we spent. Depreciation, because it's based on that. Gain or loss on disposal of old assets, because those are also based on that original cost. However, as I said, salvage value will be relevant. So if someone will pay us $1,000 to take the old machine off our hands, that's salvage value or residual value. That will be relevant, a relevant revenue specifically, if we make the decision to sell the machine. Now, sometimes as we get into the decisions we'll see, sometimes people think that fixed costs are never relevant. Well, they could be. Let's see that in D. We'll see the fixed costs may be relevant sometimes, especially in the long run. Fixed costs will not change between the alternatives. Fixed costs which will not change between the alternatives are always irrelevant, and they're often termed unavoidable fixed costs. So if a fixed cost is going to be the same, no matter if we keep the old machine or sell it, it's irrelevant. It's unavoidable, no matter which decision we make. Well, conversely, all variable costs may not be relevant. I say that because oftentimes people think that all variable costs are relevant. And also, we must always consider the total effect of the alternatives on the company over the relevant time frame for the decision. For example, in the machine replacement example, we're going to have a 3-year time frame. We've got to consider what happens in all 3 years. So consider all the relevant costs and relevant revenues over that 3-year time span. Well, unit costs can often miss if fixed costs are irrelevant. So we can't always use unit costs, although unit costs can be used in some situations. Again, we'll be doing special analyses and we'll see those things at work. Then E. One limitation of this chapter is that the time value of money and income taxes are not considered in order to more clearly present the concepts. But these topics will be covered in the next chapter on capital budgeting. But sometimes we just can't complicate matters with too many topics at once, or you won't learn the basics. And F, we'll keep in mind that dollar figures are not the only input to this decision. Qualitative factors may be relevant too. We'll discuss possible qualitative factors at certain points in the chapter. For example, if we're insourcing the product, like we'll have an example of pizza sauce. It's a pizza parlor. So this pizza parlor is currently making or insourcing sauce. They're thinking about outsourcing it or having someone else make it. Well, one factor might be quality, because if we're making our own homemade sauce, maybe diners like that a whole lot more. So we may not wish to turn loose of that and let someone else make it and have it not taste as good to diners. All right, that's where I got to in my first class. So I'll encourage a material there. And to let you know, as far as the upcoming exam, March 31st, you'll be on 3 chapters. So 19, 20, and 22. And it'll be the same format as before. So go through the learning curve. Any questions? All right, told you it wouldn't be a bad day. So go ahead and enjoy your day, despite the rain. And I look forward to seeing you on Tuesday. Have a great weekend. Take care. Bye-bye. Bye-bye.